It's good to be with you today. As I've observed over the decades, the financial markets, much like life itself, are a complex dance of knowns and unknowns. Let's peel back the layers on some recent developments that warrant our attention. The Prophet's proclamation, more than just a forecast. In 2025, the Fed won't be cutting interest rates. While this prophet has a knack for being right, their pronouncements rarely bring good news. That's because this isn't just a prophet, it's an insider, often a planner. Think back to 2008. If you'd whispered doubts about Lehman Brothers then, you'd have been laughed out of the room. Millions relied on Lehman for steady returns, no questions asked. However, just 6 days before their bankruptcy, a firm too big to fail, our prophet, downgraded Lehman's credit rating from investment grade to junk. 6 days later, Lehman vanished, taking countless fortunes and lives with it. Coincidence, you say? A few years ago, the prophet reappeared, directly downgrading a Chinese behemoth, also deemed too big to fail, to junk status. The world scoffed, but the outcome is now common knowledge. Evergrande collapsed, and Chinese home prices plummeted. Decades of savings, halved just like that. Recently, after a long silence, the prophet has re-emerged. This time, it's Moody's. Why now? Because this wolf in prophet's clothing is preparing for another legal plunder. Warren Buffett's shadow behind Moody's. Many might not realize that Moody's largest shareholder, this grinning, Coca-Cola-loving, Santa Claus-esque prophet, is none other than Warren Buffett. Moody's business is simple: credit ratings. An A rating tells investors your company is safe, stable, you get lower interest rates on loans, lenders line up, but drop below BBB and you're junk. In 2007, Lehman held a mountain of distressed mortgage-backed securities, their value long diminished. Yet Moody's kept them at an A rating. What does that tell you? Just recently, my bank manager suggested I invest in a stable, A-rated financial product with a guaranteed 5% annual return. The only risk being the company going bankrupt. Sound familiar? It's a carbon copy of 2008. Put money in a bank, get offered a safe Lehman product, too big to fail, only to find their assets were worthless. Lehman's CEO even flew to Buffett's home, begging for a bailout. Buffett offered terms, 9% annual interest, and the right to buy Lehman shares at $40, the liquidation price. The CEO refused. 3 months later, Moody's downgraded Lehman to B, market confidence evaporated, shares plunged 93%, and the firm filed for bankruptcy, igniting the financial crisis. 10 days later, Goldman Sachs teetered on the brink. Their CEO made the same pilgrimage to Buffett, agreeing to any terms. Buffett acquired stakes in both Goldman and General Electric at rock-bottom prices. It's simple. If Lehman wouldn't sell to him, others would after the fall. Recently, right after Buffett stated at the Berkshire Hathaway shareholder meeting that the dollar was headed to hell, Moody's, with Buffett as a major shareholder, surprisingly downgraded US government bonds. Simultaneously, the Federal Reserve announced no more interest rate cuts. The dollar index and US bond prices immediately plummeted. This signals that more and more market participants are selling dollars and US bonds. It means the white gloves, those with legal licenses to plunder and kill, have finally made their move. American financial speculators have stockpiled nearly enough ammunition. If you wish to avoid being a casualty this time, or even to advance your position, stay tuned. Deconstructing the Fed's narrative, a deeper game. Who truly dictates U.S. interest rates? The Federal Reserve, ostensibly. Their stated condition for rate cuts: average inflation below 2%, stimulating the economy with cheaper borrowing. But consider this: in 2020, with inflation nowhere near 2%, the Fed slashed rates to zero and unleashed unlimited quantitative easing. Their rationale? Rising unemployment due to the pandemic. They even added a new condition: if unemployment rose, they'd cut rates and print more money. Then, last year, the Fed suddenly shifted, citing high inflation and a strong economy as reasons not to cut rates. Yet, by September, with inflation still above 2%, they abruptly cut anyway, blaming too high unemployment. And just this month, they lowered the bar again. No need for average inflation below 2%. A single instance below 2% is now enough. The goalposts keep shifting. Does the Fed truly base its decisions on these public conditions? Or does it operate from a predetermined stance, then craft conditions to rationalize its actions? Soaring prices and unemployment, do they truly matter to the Fed or the US government? If so, why are tariffs imposed, making goods more expensive? Why are employees laid off, increasing unemployment? By these metrics, one might conclude that Trump was right. The Fed's rate cuts are already too late. You don't need statistics. A trip to New York will reveal the severity of inflation and unemployment. The real driver: US Treasury bonds and dollar dominance. So, what's the truth? Look at the chart. The blue line is the US bank deposit rate, set by the Fed. The red line is the 2-year US Treasury bond yield. They move in tandem. When bond yields rise, bank rates rise. When bond yields fall, bank rates fall. Crucially, the red line always moves first. US bond yields dictate the Fed's actions, not the other way around. This pattern holds true for 10, even 50 years of data. This isn't coincidence. The truth is, for the US government, the Fed, and the capitalists, there's only one overriding concern. Can US Treasury bonds be sold? Can the dollar maintain its global dominance? It's simple. If bank deposit rates are 5% and US Treasury yields are 4%, who buys Treasury bonds? You deposit your $1 million in the bank for 5%, not lend it to the government for 4%. So, when bank rates are higher, Treasury bonds become unattractive. Conversely, if bank rates are 4% and Treasuries yield 5%, everyone pulls money from banks to buy bonds. Some might even borrow at 4% to buy 5% Treasuries, pocketing a risk-free 1%. This creates a run on banks, potentially leading to a financial crisis. Hence, bank rates and Treasury yields cannot diverge significantly. Why does the Fed follow Treasury yields, not vice versa? Some say Treasury yields are market-driven and uncontrollable, while Fed rates are controlled. But are Treasury yields truly uncontrollable? In 1991, Salomon Brothers, a bond investment firm, manipulated the Treasury market by exceeding purchase limits and hoarding bonds, driving down prices and skyrocketing yields. And guess who was on Salomon's board at the time? Warren Buffett. More recently, in 2023, when BlackRock and other financial giants bought US Treasuries at rock-bottom prices, yields surged by 40%. This is no accident. So, while the Fed seemingly decides rate cuts, it's the US Treasury yield that truly dictates their actions. And if someone can control Treasury prices, they can control the Fed's rate movements. As I've said repeatedly, the capitalists pull the strings behind the Fed. Are rate changes for the benefit of the American people or for the benefit of the capitalists? The master plan: driving down US Treasuries for profit. If you grasp this, you'll understand what's coming when Moody's downgrades US Treasuries, when bonds are constantly sold off and their prices plummet. When 10-year Treasury yields continue to soar, do you still think the Fed will cut rates? Many believe if the Fed raises rates, asset prices fall, so they sell. If the Fed cuts rates, asset prices rise, so they buy. But is that always true? In 2023 and 2024, when the Fed was raising rates, we could make money. The dollar soared and the US stock market climbed. But late last year, when the Fed began to cut rates, the dollar plummeted, and the US stock market even faced a crisis. In other words, asset market movements aren't directly tied to Fed rate hikes or cuts. Profit or loss hinges on your strategy and trading principles. While we don't have Buffett's inside information, we have flexibility. Buffett needs a year to sell shares. We need only an hour to make a decision. We can profit and exit quickly. Why do US capitalists want Treasury prices to fall? Some might argue this is illogical. Buffett holds over $300 billion in US Treasuries. Wouldn't falling bond prices hurt him? No. Buffett holds short-term Treasuries, 3-month, 6-month, or maximum 1-year maturities. When these mature, the government pays him back principal and interest. So, price fluctuations don't affect him as long as he holds to maturity. Moreover, when short-term bond prices fall, yields rise. So, when his current holdings mature, he can buy new bonds at cheaper prices and higher yields. Falling bond prices and rising interest rates actually benefit Buffett, who holds vast amounts of cash and short-term treasuries. As I mentioned last week, the US government faces a current predicament. Nobody wants to buy long-term bonds. American capitalists only buy short-term. Previously, the US borrowed at very low rates for 10 to 20 years. Now, they're borrowing and repaying every month or 6 months at much higher rates. The capitalists get repaid, then lend the money back to the government at even higher rates in a continuous money-sweeping cycle. So, as long as US Treasury prices continue to fall, capitalists can keep lending to the US government at high interest rates, printing money and profiting. They can even catch fish with bare hands. During the 2020 pandemic, the Fed bought mortgage-backed securities from private banks like Goldman Sachs and Citigroup to stimulate the economy. The interest rate these banks paid the Fed was around 2%. Essentially, the Fed lent these banks trillions at 2%. Then, the Fed began raising rates to around 5%. These banks then redeposited the money they borrowed from the Fed at 2% back into the Fed at 5%, earning a risk-free profit from the interest rate differential. The higher the Fed raises rates, the easier it is for these capitalist banks to profit from this spread, effortlessly draining money from the Fed. So, is it beneficial or harmful for capitalists if US bond prices fall, interest rates surge, and the Fed keeps rates high? Some might think, but aren't Goldman and Morgan shareholders of the Fed? Wouldn't sucking money out of the Fed just be moving money from one pocket to another? You're right that capitalists are behind the Fed, but the Fed's profits or losses don't directly affect them. If the Fed makes a profit, it's remitted to the US government. Shareholders get nothing. If the Fed incurs losses, like now, shareholders don't have to cover them. The US government continuously injects funds into the Fed. In other words, if the Fed loses money, who ultimately bears the cost? The US government. Therefore, as long as US Treasury prices continue to fall and interest rates continue to rise, the Fed cannot cut rates. And if the Fed can't cut rates, the capitalists can continue to lend to the US government at exorbitant rates, continuing their blood-sucking operation. But if these capitalists drive interest rates high, refuse to cut them, downgrade US bond ratings, and even declare the dollar is headed to hell, they'll make enormous profits. But wouldn't that cause the US to collapse? Wouldn't the US government's ability to repay its debt worsen? The important question is, can the US government repay its debt? Historically, US Treasury bonds have primarily been repaid by the Fed printing money. So, a US bond default, or the collapse of the US, doesn't really exist. The only issue, as I explained last week, is that no one wants to buy US Treasuries anymore, and the money the US has spent cannot be recovered. Moody's recent downgrade of US Treasuries means they're no longer the world's safest asset, now ranking 12th. Moody's is signaling to the world that other countries' bonds, like those from Europe, Australia, Canada, are safer than US Treasuries. This will trigger massive capital outflows from the US to these other nations, depreciating the dollar. If, as Warren Buffett suggested, the dollar indeed goes to hell and loses significant value, then we'll see a new version of the Plaza Accord, a Morago agreement for our times. This agreement won't require your consent or signature. If the dollar depreciates, your country has effectively signed on. Have you noticed? Buffett not only publicly criticized the dollar, but also praised Japan, stating he won't sell Japanese stocks for the next 50 years. I'll be blunt, I don't know if Warren Buffett will be alive in 50 years. I only see what's happening now. Even many people around me who never invested before are now rushing to Japan because of Buffett, buying not just stocks, but even homes. That's why I started allocating investments to the Japanese yen last year. And the yen has consistently risen, while the dollar has consistently fallen. If you saw my previous video, you know Buffett can't directly sell all his dollar holdings for yen, but he can influence others to sell dollar-denominated assets for yen-denominated assets. This, in turn, boosts the value of his pre-invested yen assets, just as a single statement from Trump can trigger a global stock market crisis. A word from the Oracle of Omaha can send an asset soaring. That's the power of the stock market. I've strayed a bit. What if you want to buy something, but sellers won't sell? How do you force them to? First, you inflict losses. If the dollar depreciates and you're a Japanese financial institution holding $3 trillion in dollar assets, a mere 10% dollar depreciation means a $300 billion loss, right? The next step is to force them to take significant losses and dump their assets. Look at this chart. The top is US Treasury prices, the bottom is the dollar exchange rate. Historically, when US Treasuries fell, the dollar rose. When Treasuries rose, the dollar fell. This meant if Japan held many US Treasuries, even if bond prices fell, causing a loss, they'd gain from the exchange rate when converting dollars back to yen, offsetting some of the loss. However, starting this year, when US Treasuries fall, the dollar also falls. This means Japanese financial institutions holding US Treasuries are facing a double whammy: losses from bond depreciation and further losses from dollar depreciation. As a result, Japanese bond funds have already defaulted, forcing them to sell their US Treasuries at a loss. What happens if the dollar continues to depreciate? More financial institutions worldwide will suffer double losses, just like Japan, from both US Treasuries and the dollar. These institutions often use leverage to buy US Treasuries. When banks discover their assets are losing value, they demand early repayment or additional collateral. Unable to comply, these institutions will be forced to dump their holdings. So, if the dollar and US Treasuries continue to fall, many large global institutions will be wiped out, forced to sell assets to cut losses. Just a few days ago, Japan's 20-year bonds couldn't even find buyers, causing their bond market to collapse and yields to surge to 3.5%. Meanwhile, Japanese bank deposit rates are only around 0.5%. This implies that if Japanese bond yields continue to rise, people will withdraw money from banks to invest in bonds, draining Japan's banking system. To counter this, the Bank of Japan has no choice but to raise interest rates to stem the outflow. The BOJ has already acknowledged that a rate hike is not out of the question. Once Japan raises rates, the yen will continue to appreciate and the dollar will continue to depreciate. I've said it many times. Countless people worldwide are currently borrowing from Japan at 0.5% and depositing it in US banks at 5%, profiting from the interest rate differential. But once Japan raises rates, this carry trade will become far less profitable, potentially even incurring losses due to dollar depreciation. Consequently, many leveraged financial institutions engaged in this trade will face margin calls or demands for early repayment. This will trigger a massive conversion of dollars to yen, further depreciating the dollar and strengthening the yen. This, in turn, could solve the US Treasury sales problem, allowing the US to rise from the ashes. Why? It's simple. If you're Japan or any other country holding vast amounts of dollars and US treasuries and this system collapses, what happens? First, years of your company's efforts become worthless. Second, your economy could collapse instantly. If you don't want that, your only option is to keep buying dollars and US treasuries. You must keep holding these assets to avoid even heavier losses. Otherwise, as I said last week, you'll be hit by tariffs and dollar depreciation, making your exports uncompetitive. The outcome would be similar to Japan's current economic situation: 30 lost years. Or consider this: many people recently saw the US stock market recover and invested. As a result, the new Taiwan dollar appreciated by 10% in 2 days. This means regardless of your US stock investment profit or loss, you've already lost 10% just converting dollars to NTD. So, if you want to stabilize your currency's exchange rate, you must buy dollars and US treasuries. I've covered this before. Refer to my previous videos. For me, I sold all my US stocks last year. Besides seeing the big players offloading from the charts, the key factor was the risk of dollar depreciation. So, I converted my dollars to Japanese yen, gold, and Bitcoin as hedges against a weakening dollar. If your main currency isn't the yen, you don't necessarily need to follow me into yen, as the dollar is likely depreciating against most global currencies. You might find lower risk investing in local assets with your domestic currency. Whether it's Hong Kong or Taiwan stocks, their trends often mirror the US market. So, why expose yourself to additional exchange rate risk with a depreciating dollar by investing in US stocks? Think about it. If the US stock market collapses this time and the dollar collapses too, who benefits the most? Warren Buffett. Our investment methods may differ from Buffett's, but our strategies are the same. We're both accumulating ammunition, waiting for a clear trend in the US stock market after its correction. Will it collapse as we predict or rebound? Whatever the outcome, it won't affect our actions. When the time comes, we can use the profits from other markets to reinvest in US stocks. For Buffett, the US stock market is his home turf. He's just getting off the train before it crashes to protect his capital. In principle, Buffett is a large investor, and we are retail investors, so our playbooks and plans differ. But our investment strategies are nearly identical. Will reality unfold as we've analyzed? How will we adjust our investment strategies in the next phase. Time is limited, so I'll stop here for today. I freely share information on how to become wealthy, an entrepreneur, an investor, and achieve financial freedom. If you don't want to miss out, subscribe, turn on notifications, and share this video generously. I sincerely wish all of you who like this video early financial freedom. If you found even 1 or 2 useful insights today to improve your life, I am content. What are your thoughts on these market movements? Are you seeing the signs too?